So we all know what happened in crypto over recent weeks. FTX, the second largest crypto exchange in the entire world, fell apart. And at first, it seemed like this was just a little bit of a regular run on a bank. Maybe they had run out of liquidity. But very quickly, though, things weren't adding up and accusations started to pile up of fraud and wrongdoings. Before long, those accusations turned into evidence, and now we're staring down the barrel of one of the biggest and largest and greatest frauds of the 21st century, all run by some weird 30-year-old nerd with an addiction to League of Legends and no sense of right or wrong. As this story has been developing and as we've been learning more and more, people have started to point out the similarities between this FTX crash and Sam Bankman-Fried and what we saw back in 2001 with Enron and 2008 with Bernie Madoff. This narrative has been pushed along by the fact that the new CEO who's been appointed to work out exactly what happened with FTX was the exact same person who ran the restructuring of Enron back in the 2000s after their massive, monumental, multi-billion-dollar fraud, and it's safe to say he knows a fraud when he sees one. In terms of the scale of this fraud, FTX's seems to be somewhere in the region of 30 to 40 billion US dollars, about half of what we saw with Enron, but the total damage to the markets from FTX extends far beyond the amount of money that they simply stole. We've seen the crypto market lose over 200 billion US dollars in value over the last week or so, and the US stock market lose about $500 billion as well. It really should be very clear at this point that this is a fraud on the same scale as Enron. As for what the new CEO has to say, well, he's been notably restrained as he is now in a position of authority with FTX, and he has a responsibility to put its shareholders, its customers, and the business itself first, but he has not held back from criticizing what he is seeing, even if he is not necessarily yet calling for Sam Bankman-Fried's arrest. He's quoted as saying, "The concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals was unprecedented." He also said a substantial portion of assets held within FTX may be missing or even stolen. Finally, the most damaging thing that he revealed is that Bankman-Fried and FTX management practices included the use of an unsecured group email account as the root user to access confidential private keys and critically sensitive data for the FTX group companies around the world, the absence of daily reconciliation of positions on the blockchain, and the use of software to conceal the misuse of customer funds. It is very safe to say at this point that it's game over for Sam Bankman-Fried. The wolves are coming for him and the trail of blood is so large that there's just no way he manages to invade their jaws. To call him the crypto Bernie Madoff really isn't as extreme a comparison as many had earlier thought. But this video, we're going to look at some of the newest developments, at what exactly we've learned over the last few days, and what it means for this whole story as we go forward. It's no secret that the market has been embroiled in turmoil throughout 2022, with inflation, rate hikes, crypto collapses, and mass layoffs across the entire world, meaning asset prices have been getting hammered. That's why you watch Stoic Finance, but that's also why you need to check out the Tendies app on iOS and desktop today. The Tendies app is the first serious attempt to integrate trading tools with a social media platform. I personally love the filtered order flow. You can see whale purchases, a ranked chart of bid and ask spreads, and overall flow sentiment for free. I've been writing a video about Meta recently, and well, you can see the options flow data in real time right here. Other companies are charging $40 to $350 per month for the same type of data that Tendies is giving away for free. With Broker Connect, you can integrate your portfolio so you can monitor your performance and do the necessary research to be profitable in this environment. All the due diligence is in one place, and you have access to a constantly refreshing feed of information relevant to your portfolio and the stocks in it. So filter out the noise and use Tendies. I love it. Make sure you click the link in the description and take advantage of this market chaos. Now, the first thing we need to talk about is the fact that Sam Bankman-Fried had automatically deleting messages that he used to direct the business. According to the new CEO himself, One of the most pervasive failures of the FTX business in particular is the absence of lasting records of decision making. Mr. Bankman-Fried often communicated by using applications that were set to auto-delete after a short period of time, and he encouraged employees to do the same. I.e., he would say something like, move 200 million of these tokens to this wallet and go get a loan from a bank using them as collateral, then give that money to our trading arm and instruct them to gamble with it, and then 10 minutes after that message was sent, it would suddenly disappear, leaving no trace at all. He not only used this system himself, but he actually encouraged his staff to do the same thing, telling them that it's safer, more secure, and just a good idea all around. This is like a spy message that self-destructs after a minute to ensure no paper trail is left behind. Normal people do not do this. Legitimate businesses do not do this. They want records, they want proof of what was said by who, and this is a telltale sign of total and utter fraud. Now, just one of the frauds that they partook in was FTX trading, or actually just gambling with their customers' assets to try and make a profit. Now, we've known about this for the better part of a week now, and in essence, crypto exchange FTX lent billions of dollars worth of customer assets to fund risky bets by its affiliated trading firm, Alameda Research, setting the stage for the exchange's implosion. FTX extended loans to Alameda using money that customers had deposited on the exchange for trading purposes, a decision that Bankman-Fried described as a poor judgment call. All in all, FTX had $16 billion in customer assets, so FTX lent more than half of its customer funds to its sister company Alameda. Of course, Alameda also took out a bunch of loans from other places as well, from financial firms and investors, so they owe these people about $1.5 billion on top of the $8 billion they owe FTX as well. Many people are claiming that this is just FTX not really knowing the rules and accidentally getting them wrong, but I really don't think that is at all consistent with what we just spoke about, and certainly not consistent with the next thing we're going to talk about. Sam Bankman-Fried was taking customer funds, giving them to a trading arm that he also owned, and telling them to gamble to try and make money. He knew 100% that what he was doing was wrong and even illegal because it is the most obvious thing in the world. Now, fraud is a big word, so why am I using it? Can I really be sure that this wasn't just an accident, some mistakes being made along the way? Yes, but nothing criminal. Well, yes, I can say for certainty that this was fraud. Alameda Research, again, the trading arm of FTX, so a company basically owned by FTX that trades crypto to try and make a profit, has now been exposed as insider traders, which is very illegal, yes, even for crypto. What they were basically doing is trading on inside information, using their connections with FTX to find out which crypto will likely increase in value next. Now, many crypto coins are very low in value, they're not very popular, and they're also low in trading volume because there are just so many of them all over the place. When a coin gets added to a big exchange like FTX though, it suddenly gets much more attention, it's far easier to buy or sell it, and it gets much more visible, so naturally the value of these coins rises. FTX would select in advance which coins they were going to add to their exchange, and knowing that the coin was then going to go up in value, they told Alameda Research this information, who then went out and bought millions and millions of dollars worth of the coins. A week or a month later, and they would then sell the coins for a massive profit. This is all detailed by a blockchain data company called Argus, who went through all of these blockchains and detailed the transactions we saw very clearly happening. Now, to prove that this isn't just some fringe conspiracy theory, here's an article from the Wall Street Journal detailing this exact story. On the days that FTX said it would be listing tokens between the start of 2021 and March of this year, Alameda had roughly $60 million worth of tokens combined across 18 listings of coins. What we see is they've basically almost always, into the month leading up to it, bought into a position that they previously didn't. It's quite clear there's something in the market telling them they should be buying things they previously hadn't. Now, Sam Bankman-Fried was loosely accused of this before, back in February, and claimed that Alameda had the same access to information as all other market makers on the platform, and that its traders didn't have special access to client information, market data, or trading. This is, though, incredibly dodgy to say the least, as the evidence speaks for itself. On 18 separate occasions, Alameda made the bet of a lifetime and successfully predicted within a month which coins would spike in value as they got listed to FTX. The connections between the firms aren't great for the fraudsters either. Alameda is literally owned by FTX, and Sam Bankman-Fried, the CEO of FTX, has a sexual relationship with the woman who ran Alameda Research. Combine this with the fact that SBF has been periodically deleting all his messages to get rid of the evidence, and I think it's pretty safe to say huge amounts of fraud and criminal activity was going on here. Also, many people are claiming that this isn't illegal or it isn't even insider trading because it's crypto and it's unregulated, so it's all okay, except we've already seen earlier this year 3 Coinbase employees go to jail for doing exactly what FTX have done because it is insider trading. I made a video on it at the time, but in essence, these Coinbase employees had access to which coins would be listed on the website next, and they went off with their own money and bought those coins first to make a profit from it. They ended up getting caught and going to court for it, and then they went to jail. But for FTX, the situation is much worse because in that instance, it was rogue employees, whereas with FTX, it's a company-wide directive to commit insider trading. Now, at this point, it should be clear that this wasn't an accident, it wasn't a mistake, it wasn't even negligence, it was malicious fraud and just outright theft. It was 100% criminal, but many people are still standing by FTX and SBF, refusing to admit that they were wrong at all, making out like this is just a run-of-the-mill story and nothing to actually pay attention to. The first person to talk about, and actually quite a heinous example of this, is Kevin O'Leary, an incredibly famous investor who you no doubt know from Shark Tank, who in more recent years has been making YouTube videos, and he's actually just basically become an entrepreneur influencer, much like Gary Vee. Well, he was a paid spokesperson for FTX and an investor in the company itself, a part owner, and he's supported FTX for a long time now. Now, I'm not suggesting that he should have known exactly what was happening inside, because frankly, none of us did, but I am suggesting he ought to grow a pair of balls and admit he was absolutely wrong and tell everyone to stay the hell away from Sam Bankman-Fried and FTX, but he's not doing that at all.
I watch Shark Tank. One of the things you've said repeatedly on Shark Tank is that you are happy and you prefer to back entrepreneurs that have failed before because they've got more experience, they've failed before. If SPF knocked on your door again and said, look, I failed in my last venture, I have a new crypto venture, I need money, would you back him?
That's a great question. No one's asked me yet. I think we can all admit, you can love him or hate him given what's happened, but he was one of the most brilliant traders in the crypto universe. He also built one of the most robust platforms. We used FTX actively. It was a very robust platform that allowed us to get information on a compliant basis. So I really like what he built.
Would you back him?
The answer would be yes.
Kevin is saying that he would actually invest in a new crypto company with SBF again, despite the fact that he lost his entire investment with FTX and the fact that he had assets on FTX that were being gambled with, and he's lost those too, worth hundreds of millions of dollars. He is so filled with hubris that he simply can't accept and admit that he was wrong, so instead he claims that SBF is a good guy who made a mistake, and actually he's a genius and incredibly successful as well, which is utter lunacy. Kevin is just completely ignoring the fact that he was a good trader because he was breaking the law. Unfortunately though, Kevin isn't the only one giving Sam Bankman-Fried the benefit of the doubt, despite the fact that he doesn't deserve it at all. The New York Times came out with this piece titled "How Sam Bankman-Fried's Crypto Empire Collapsed," which on the surface doesn't seem to be anything weird, but the actual article itself is dedicated to rewriting history to try and remove blame from Sam Bankman-Fried. Frankly, I can put it no better than Matt Novak from Gizmodo. The new article in the New York Times by David Yafbalani lays out the facts in ways that are clearly beneficial to SBF's version of the story and leaves many of his highly questionable assertions without proper context or even the most minimal amount of pushback. The result isn't to illuminate the shadowy world of crypto. It reads like if the Times had conducted an interview with Bernie Madoff after his Ponzi scheme collapsed and ultimately suggested that he just made some bad investments. The article comments on Alameda Research but ignores the fact that he had a sexual relationship with the woman who ran it, that he was feeding insider information to Alameda Research, and that it wasn't actually FTX's money that they gave away to gamble, it was FTX's customers' money. The article then goes on to try and remove any sense of responsibility of the collapse from SBF himself, speaking with him directly and allowing him to claim that had I been a bit more concentrated on what I was doing, I would have been able to be more thorough. That would have allowed me to catch what was going on the risk side. SBF didn't just miss the risks of what was happening, he purposely ignored them because he believes personal responsibility is a myth. Now, I know most of you won't be surprised that this is coming from the New York Times. They have been one of the worst legacy media outlets when it comes to truth, honesty, and integrity for years now, and so this is no departure to the norm for them. Finally, though, a quick note on Sam Bankman-Fried himself and his upbringing from his parents. Now, it's quite well known at this point, but SBF's parents are both compliance lawyers who lectured at university and who helped businesses ensure they're not breaking the law, which is incredibly ironic because that was seen as a point of confidence in SBF by many. But actually, his mother in particular is one of the most violently left-wing academics I've ever seen in my life, who claimed in a 2013 paper published in the Boston Review that the philosophy of personal responsibility has ruined criminal justice and economic policy. It's time to move past blame. She literally claims in this paper that personal responsibility is a myth, that it doesn't exist, that people have no control over their actions, and that it's time to move past blame. That is the ideology that she instilled in her child that made him go and steal billions of dollars from innocent people because, according to Mummy, it's not his fault, it's just his nature. Now, something not being missed in this day and age is the similarity to other major recessions, market crashes, and frauds that we've seen in the past. The dot-com crash of 2000 decimated the market, but it also decimated one of the biggest and most successful companies in the world that was actually just one giant fraud, and I'm of course talking about Enron. Then in 2008, we had the global financial crisis, another massive market crash that led to the collapse of one of the most successful investors of all time called Bernie Madoff, who it turned out wasn't a successful investor at all, but just a charlatan who ran the world's largest Ponzi scheme. Now, in 2022, the COVID response is finally catching up to us, and we are entering a recession with markets being down by more than 20% across the board, and FTX has just collapsed, an American company led by American employees with a fraud on a similar scale to that of Enron and Bernie Madoff. Some people are claiming that this is a sign we're at the bottom of this crash, that once the major frauds are uncovered, that's when the markets start to rise, but that is unfortunately just not true. Enron died in December of 2001, and the markets kept on falling until early 2003 for more than an entire year. Bernie Madoff saw his collapse in December of 2008, and the markets didn't exit that bear market for about another 6 months. The sad truth is that this bear market is likely going to continue. More firms are going to go bankrupt and more frauds are going to be exposed, especially in the crypto space, and the best thing we can do about it is just to simply pay attention. So until next time, stay stoic.